Ladies and gentlemen, welcome back to the Daily Capital Flows live stream. We have an exciting day in markets. S&P's down a little bit. Bonds are down, dragging equities all over the place, dragging the dollar all over the place. Gold and silver are down. Hype is retraced a little bit of the move, but it's holding the levels in line with all of the things that we've been talking about. And so today, we're really going to pull together a lot of the ideas that we have covered over the last week. If you've been here and you've kind of said, you know, I've been going through the live streams every single week, every single day, and going through the slide decks and everything else, this is really going to be a time where we're going to pull all of the moving parts together. If you haven't been around for each live stream, then this will be perfect for you because you'll be able to kind of get a big picture view of everything that's happening. And then if you've been on all the live streams, we're really going to synthesize all the moving parts and answer a lot of questions. So if you're here, throw something in the comment section and ask questions about where we're at as it relates to however you're managing risks, thinking about things, questions you have about the cycle, credit, hyperliquid, anything. So that's what we're going to be covering, and then James will have a couple of extra things to cover on his end as well. James, how are things going?
Pretty good. I put out a tweet yesterday that this is like one of the spots where I wanted to be wrong, but instincts kind of, I guess, took over and was a little bit of a warning sign because yesterday was a big day in the crypto landscape. And we had Saylor buying $1.5 billion or getting $1.5 billion through his stretch product. We had the Clarity Act pass through the House, moving on towards the Senate. And we had this huge kind of hyperliquid ecosystem boost with Coinbase and all that. And Bitcoin still could not push through. Yeah, that's the one. Could not push through the 82, 83K heading into a weekend. Oh, and everything out of China seemed to go pretty well when it comes to Trump Xi. There was no, I guess, animosity or any weird stuff that came out of that. So when I see Bitcoin show weakness off that and not be able to follow through and breach that, we still have maybe till Sunday to see if the end of the week it can push through. But warning signs to me going to bed last night, and I wake up and I told you, like, I've been lately trying not to look at markets for the first hour of the day. And I just had a feeling coming into work today. I was like, today's not going to be a good day out there in markets. And sure enough, I come in and just see absolute, bloodbath pullbacks across the board. So it's funny. It's funny how, intuition and stuff can come from watching markets every day.
Yeah, absolutely. I think it's interesting. I shared, I don't know if I can share this screen. Let me see. I shared in the chat. Let's see. Let me see if I can share this. Here we go. I shared in the chat yesterday that, we're entering, and let me make sure this is showing it like that. We're entering that period where we can have massive updates in per and hype. That's what we had yesterday. It's important for you to think clearly during this time and stick to your own risk management and execution process. I continue to hold my position. Nothing has changed in my thesis. Don't lose the foresight of correctly analyzing the risk reward, though. And I think the price action we are seeing is, basically moving in lockstep with this, right? When we see these moves down in bonds, which are to be expected. I mean, do I want to get aggressively short bonds? Not really. But when we've been going over on live streams and the reports, everything that bonds are coming down. And I said, bonds sell off, they're going to drag on equities a little bit. It's going to be like the CPI print a little bit, which is exactly what we're seeing today. But you'll also notice that the S&P is holding these levels. We're not going off as aggressively as everyone would expect. And, you've seen a little bit of consolidation. We haven't seen anything crazy here yet, but bonds are still sitting at these lows, right? And so you have stocks outperforming bonds. Again, another signal about where we're at. And, notice that crude isn't really up on the day. Why is that? It's because the entire question right now is not just about crude prices, but about core CPI and how that transmits into the rest of the system. And so, when you have these moves where you have that big bid in hyperliquid yesterday that we covered, obviously, my view is that you have a pretty clear inflection point right here, almost comparable to the HIP-3 rollout. You'll remember, down here, and here's just how to think about price action connected to your thesis and information. You'll remember that right here is really where HIP-3 took over. And once you had this move up right here, especially during this period of time where you had HIP-3 roll out more aggressively and a lot more volume went through HIP-3, and that really marked an inflection point for hyperliquid, then you're likely to remain above those levels, especially if HIP-3 continues its volume, which is taking place. So that is really how you want to begin to connect information with price action, because if we rolled over here in hyperliquid, it would likely be an indication of, well, HIP-3 is not working in some capacity, or it's not adding the value everyone expects. And so you've had these moves up, you've had consolidation in a very healthy manner. Same thing right here on the upside here with HIP-3 and the releases with crude, or the volume run through crude and things like that. And now this move that we had right here, where we rallied on the information that we had took place, my view is we're going to stay above this 37 level, because you just had this catalyst take place. And unless this catalyst and the fundamental information about it reverses, so whatever, just say you don't even know the catalyst, whatever took place yesterday, is that thing going to persist? And does that have a future expectation about price? If it does, we're likely to remain below or above this 37 level, which is why, again, on the Substack this morning, I shared this note that says, for a tactical expression, being long hype here, 43.50 with stops at $37 is a great risk reward since we are likely to hold these levels in alignment with the information that was released. The reason why we would break to new lows is likely because something reversed or changed to that information. And so this is a clear sign of the range. This is how I view the risk reward. So the implication of this is that, let's say you're an individual who doesn't have any hype exposure or ETF exposure or per exposure or whatever that might be. We just had a catalyst come out and we have a little bit more clarity about the risk reward on a shorter term time horizon. And so me saying, okay, you know what, I mean, we're, now 25 cents above when I laid that out, but same spot, not really that significant of a change, at this 37 level. It's right here. So if we have, a risk of at 37 and you have, let's just say we're going to hit all-time highs right there. And you say, well, what would the variance be for this on whatever time horizon that might be? I think that's a very reasonable risk reward trade to take. And, if you begin to move on size, you can put your stops to break even. It's a 3-1 risk reward. And that's how I view the risk reward of Hyperliquid right now. And I think the entire point, this goes back to the tweet by James, is that he's doing this even though it's against his position. So, James is obviously long Bitcoin. He's talked about that a lot on streams and what that means. But he also has the ability to say, okay, well, how is the objective risk reward changing on multiple time horizons, whether that's an hourly, daily, weekly? How is that changing, even if it contradicts my view on a longer time horizon? He says, okay, I think it's going to go up over a couple of years. That's the position I want to have because of these factors. But having the awareness to be able to shift and have these types of views is what allows you in the first place to have trades like this to get on sides. And, when we talk about trades like this getting on sides, let's say we just have this, you get on sides, you put your stops at break even or whatever it might be, or you have a rolling stop, then you might have another catalyst in a month and you put more exposure on and put your stop somewhere and you're still protecting principal. And so you just keep running, in a sense, one-off trades. They should be connected, but one-off trades in a asset that allows you to get more and more exposure on sides and take volatility that no one else wants to take. And I think that's kind of a really key takeaway for your entire comment there, James.
Yeah, Druckenmiller was always talking about this too, how he operates in like different silos of time, and you have to be able to try and compartmentalize them as best as you can objectively. And it's really hard, like it's really hard because you just want your base level foundational thesis to be right. You want to see things go up. That's why it's hard to be a Bitcoiner sometimes. But the one of the things I really like about the Hyperliquid position is that it's established. It's not some sort of like hype coin that is driven by memetics and crazy outlandish positioning or whatever. It's established this insane foundation of a range and why it's priced the way it's priced. And it's actually got revenues that people can kind of rely on. And sometimes that's a little bit annoying because you'll see some of these other high flying things happen in the face of bullishness and hype won't move as much. But the asymmetry that lives within this position is so good and so hidden because the downside to me is a lot more controlled based on all the things that are stacking up over time. And Per just added a really nice one that I think I'll have to dive into a little bit more, but it's that partner. I still think that partnership with Trade XYZ is a big deal because as Trade XYZ continues to become a far and away leader on HIP3, they're going to become the trusted name. And Shoku, their guy, is like one of the most trusted voices in Web3. So like as they continue to build out their lead in HIP3 and get more and more tickers and more liquidity, their validator is going to grow and grow and grow and grow. And now Hyperliquid Strategies, or Per, has partnered with them for that validator, and that will add another vehicle to increase income that other hype DATs just don't have. And I think that's just a huge thing. Just this little stuff like that, I think, adds to your asymmetric bet as we're adding layers and layers to the page here. But yes, when it comes to Bitcoin, like sometimes I'm just like, yeah, well, I don't love the next week or whatever this may be, but it is what it is. We're along for the ride.
I think the other kind of thing to stack on top of that is that analyzing the downside here is very important, right? A lot of people don't want to ask these questions about what is the downside for Hyperliquid? What happens if these things don't go through? And here's the thing, asset managers or, like we need the ETFs because they're great financial products. But at the end of the day, an ETF, what do they want? They want more assets. So they're going to have a view that's bullish, right? And that's totally fine. They're part of the system. They're a very integral part of the system. You just have to understand why they're taking place. In the same way that like a hedge fund, if they're giving you free information, you should be like, why are you giving me this information, man? Like you should ask that question if some player is giving you information. And in the same way, you should ask, why does this person have this view? How are they talking their own book? Are they trying to give me misinformation? What does this mean? And again, that takes place in markets all the time. But the downside for Hyperliquid here is, let's say it doesn't get added to the United States. Let's say there's issues with that or whatever it might be. The base case is that we continue printing revenue at the same pace that we are at right now, adding derivatives, and international markets are using Hyperliquid as the US is sidelined for a little bit. So that's the downside. The downside is we're producing cash flow. And I think that's just one of the most critical things. That's why there's uncorrelated returns in Hyperliquid right now, because people recognize that in the interim of it getting added to the United States, it has upside, which is massive because this is not a binary bet. It's not, oh, it gets added to the United States, I make money. This is not a poly market bet. It gets added to the United States, I make money. If it doesn't, I lose money. Even if it doesn't get added to the United States, which I believe it will, but here's the thing, I could be wrong, right? As a trader or someone who's managing money, you need to always think about the counterfactual. And so that's why I noted, hey, if we're in a period of time where things are really aggressively pumping and you know what's taking place, you want to think very clearly about that. And so that's why I think that the downside is limited for Hyperliquid because of that exact dynamic where it's just printing money in the interim of having the out-of-the-money call option. So it's like buying an out-of-the-money call option that pays you a yield. That's what Hyperliquid is like right now.
Yeah, and just to keep in mind this chart here, and I can widen this a little bit. This is the Hype BTC chart that I always keep on my watch list. And if you spend any time in crypto, you'll know that most things underperform Bitcoin over time. And Hyperliquid is one of the few that has shown this trend that has been threatening to really break out a few different times to where you could see a complete dislocation. And I think, going back to your original thesis on this whole thing, if you see that, that could actually be where you see the real run in Hyperliquid and therefore in PER, right? And I don't think we've seen that yet. That's, I think, a little bit tapped into your message the other day about what we could potentially see. And it's just something, if you guys are not looking at this, like if you were to put this chart up for literally pretty much every other crypto, I think maybe every other crypto, it goes down and to the right against Bitcoin.
It goes to the right?
Down and to the right. Yeah. But like, you know what I'm saying? And I just think this is something super important. And it's one of the few products that's actually proven itself in the ecosystem. It goes back to your Trojan horse thesis. And it's all in there. But I think it's important to realize that, yes, it's like the downside is probably, if I had to put numbers on it, 30 to 40%. And the upside is hundreds and hundreds and hundreds and hundreds of percent.
100%. Yeah, I agree. I think that the additional thing on the ETF side that I think is really interesting, and we're already seeing this with the ETFs, is that, if you stake in an ETF, you can't get that out right away, right? That's the entire point of staking right now, right? You can't get immediate liquidity. And so these ETFs, they need liquidity. That's why the first ETF that got launched, that's why they said, oh, well, we're only going to stake 20% of our hype. Why? Because if people get out of the ETF, they have to actually liquidate hype. And they probably have to have some other stipulation in there, whether it's in the docs or if it's some other deal that they've made with someone else to give them liquidity if they need to sell their unstaked, right? Because if there's a rush to the exit with a single ETF, that could dramatically impact how much hype they can have in the first place. Whereas great example, they're one of the entities that won't be forced to sell, right? They're able to actually stack that yield over and over and not just keep some of their hype in, just on the sideline, and they can actually earn yield with it and do other things with it. And I think that's what we're going to see is, we're playing it safe right now. I think the CEO and on the board and everyone there, they're playing it safe because I think that is how they want to frame expectations around the market. But the entire point is that they now have, it's like having compute, right? They're just having it. It's worth a lot, or it's like having this land that you have water rights on or something like that. They can do so many different things with it, but right now they want to see how things shake out, and they want to see how exactly the best bet that they can take is. And I think the fact that all the guys on the board at know the guys at Trade XYZ, and they're all in New York together and they're doing their thing, probably one of the most significant behind the scenes things that people don't even recognize. Whereas any of these ETF guys, guarantee you, maybe they know some people here and there, but not as locked in or connected in the ecosystem overall. And I would say, listen, I don't have anything against ETFs. I actually think it's amazing that they're doing their thing. And on the ETF side, we had the Bitwise ETF launched today. And that ticker, let me find which one that is. It's the BHYP ticker, which is, great. I think we're having a new ETF come out. We have 40,000 shares traded on the day, 50,000 shares. And the THYP one, we have a little bit less than that. And then you probably have, you have hundreds of thousands of shares trading every day. I think what are we at on a daily basis? We're at, 4 million shares. So it shows the differential. That's also why is going to be the place where options get traded first, which they're already listed, but they need to be a little bit more liquid. So you have options listed on You already have that taking place. Now, the entire question is, how are we going to really play out with all of these moving factors around the ETFs? My bias is that the Bitwise ETF is probably a better play than the THYP. So if, I don't have any, that's just my opinion. I don't have any connection to either. Neither of them are paying me anything. If they want to pay me, I guess that's fine, but I'm still going to share what my opinion is. But the idea is that I think the Bitwise ETF is probably a little bit better, but overall, I think is better than both of those right now because they still have so much potential to add value above the returns that exist. So I just think that's going to be really key.
I love it. I think it's a really interesting spot here moving forward. I think hype. I was looking at that just the basic hype chart. I don't know where I put it. Whatever. It's basically just, I think, reestablished like a base, and yep. I think it's basically effectively bought itself some time to kind of, and we'll get into this kind of macro stuff here, but I do feel like whenever you have long end yields starting to creep up, you have like the worst transition happening today. Like it's like that shadow boxing example where the market's going to say like, okay, let's test and see whether or not these longer yields and worst stepping in is going to actually be non-beneficial to risk assets. And it's testing that. And it's going to be interesting to see the response through the next week or two to say like, yep, don't care, right? That's fine. We could go into this, we could start heading towards that regime shift we talked about yesterday, maybe with like a bear steepener or something, and markets can fly. So it'll be kind of cool to see over the next, like, I would say 14 days where we're at after today.
Yeah, exactly. All right, there's a couple of questions I wanted to go over as we kind of go into these ideas that I wanted to cover today. And let me pull up screen on this. This is the for everyone.
By the way, shout out real quick to the Aichi question, which we'll touch on. But that's somebody that came from my Discord, so it's nice to see some people coming from our different channels coming here and learning every day. It's pretty great.
Who is it?
It's Aichi 2006. They just put up a question about 1 year yields.
Let's go to that one first then. I like it. I like it. Question: why do we only focus on 1 year reals, which have not moved much, but the rest of the real yield vols have moved higher, like 2 year and 10 year? Would that be a limiting factor for the melt up? This is such a good question. And we covered a little bit of it yesterday, I think, in this entire idea about the real yield curve. But this is, guys, this is the exact type of question you want to be asking. You want to say, why are you looking at one and not the other? Or how should you weight one versus the other? Really good question. Okay, so here's what you want to start with. Number one is real yields across the curve are important to understand in the same way that nominals and inflation swaps are important to understand. So let's just break this down in a very simple fashion. We talked yesterday, and again, go through the entire video and slide deck yesterday on interest rates. We talked yesterday about how the Fed controls the short end. And that's why we have these SOFR swaps or SOFR contracts and SOFR swaps that price the actions of the Fed. And notice that we're only going out, to 2030. And these are a lot less liquid, the 2031's contracts right now that are in the yellows. So you have the most liquidity in the whites and the reds, and then a little bit more in the greens and the blues. But, basically you have the first 4 years as the most liquid. So you understand that these contracts are all about what the Fed is going to do. Their expected outcome versus what's going to be realized. It doesn't matter if inflation is at 20%. If the Fed cuts into 20% inflation, this contract will settle at that action by the Fed. It doesn't matter where inflation is. This is a derivative contract. I'm now using polymarket analogies because I feel like people understand polymarket more than SOFR contracts now, which is wild, but what are you going to do? I think that you want to understand that the Fed controls the short end. As things move out, that's when you begin to have different pricing mechanisms. Now, you have inflation swaps, which are similar in that you have their pricing CPI. So again, 1 year inflation swaps, they are pricing near-term inflation risk on that time horizon. And then 2 years, 5 years, same thing. Same thing with 10 years. So the idea here, especially if you look at 30-year inflation swaps, which were much higher during this period of time, and they have moved down and been in this shorter range. And when the Fed is talking about, oh well, inflation expectations remain contained, that's because they're still in this range right here. So understanding that there is a tenor differential, right? There is a time frame differential in just the tenors across these. And then what we need to ask is say, okay, what does one tenor or one time frame, how can we understand that? And how do we understand that relative to a longer time frame? And this gets to the exact question of why are we focusing on 1 year real rates and 2 year real rates when 10 year and 30 year real rates are moving to new highs right now? And the answer for that is that it connects to the Fed and their actions relative to long-term growth. So for example, when we see the Fed acting this way, where in 1 year swaps, you have them moving down at these lower levels. 2 year swaps, they're still, they're moving up now because we're repricing things, but they're probably not going to move up too aggressively, right? Maybe we might, tick up a little bit to, around 1%. But overall, I think we're going to remain in this like lower range and make a lower high right here. The idea here is that what is the Fed doing in their actions relative to inflation? That's what the short end is doing. The long end is pricing how the long-term nominal GDP expectations are functioning, especially as it relates to the drivers of long-term rates, which are the Fed plus nominal GDP. So when the Fed is easing or not being hawkish enough, they're not really easing right now. They're because we have hikes priced on the forward curve, but they're not being hawkish enough. When that happens and they're not doing anything, the differential gets priced in the long end, which is why long end yields are beginning to rise. And let's see if we can pull this up. Notice that on the day right here, we are steepening in the curve. Notice 2s, 10s is steepening. 10s, 30s is flattening, actually, which is actually interesting. I'll explain that in a moment. But when we look at 2s, 5s, we're steepening right here. And this is bear steepening. So we talked about this yesterday. You have bear steepening in the curve, which is long end rates moving up more than short end rates. Why? Because the Fed is falling behind and long end rates are pricing their policy air. Now, with that being said, we want to connect that to this idea of real interest rates. What we are seeing right now is a short-term liquidity impulse from 1 year and 2 year real rates, because they're still at these lower levels, especially 1 years, where the Fed is deciding to look through some of the inflation. So this right here is a positive liquidity impulse on the 1 year and still 2 year, but to your point, we have them moving up a little bit, but my view is that we're not going to make a really aggressive high here, just given how we're priced on the forward curve relative to how high inflation can go. The longer end is beginning to move up, which is a risk. And that's why the curve is bear steepening, because the long end is repricing this risk. So on the short end, you have functionally liquidity getting added to markets, whereas the long end, you have it functionally contracting liquidity in markets. Now, the question is, how does that time frame differential interact with, one, the underlying growth and inflation in the economy, and two, how does that also connect to positioning that we are seeing? So right now, the fact that we are having stocks outperform bonds and stocks hold their levels and the most interest rate sensitive sectors remain elevated is an indication that even though we have real rates rising like this in the 30-year, and that is a risk to the system, that's a risk to risk assets. So when real yields are rising like this, that is creating headwinds for risk assets. Very clear. When you don't see risk assets feeling those headwinds, that goes back to that analogy I gave yesterday, where you just pushed against the guy in the boxing ring and he's a lot stronger than you thought he was. And now you have a little bit of an issue where you're going to say, oh, now rates can go a lot higher. And that's why you want to look at these rates across everything across the risk curve. That's why, and I'll connect this to the CPI level, where we have some bear steepening on the day, especially in the short end. So that tells you about the Fed kind of falling behind a little bit. So you have bear steepening and stocks selling off on the day. But notice right here, and I believe, I don't want to get this wrong, but I believe this was the CPI print right here. So we have the CPI print that came out here where stocks moved down and bonds moved down, but then we ripped back up. So now when we have this bear steepening that is pulled equities down, I'm watching this level very closely and this CPI level very closely, because this tells me how much interest rate risk that I have in the market right now. In a similar way, you know how we had information injected into Hyperliquid and now that tells you where a level is? In the same way, we just had bear steepening that pulled down the S&P 500 a little bit. And the downside is, well, the last catalyst that we had where positioning sold on a short-term basis around rates rising was this CPI level right here. And so here is where we're at for the risk reward as it relates to interest rate risk in the S&P 500. And so if we go to the extreme of pricing hikes, if we go to the extreme of pricing hikes on the forward curve, that is probably going to set the low for ES within this range right here. So that's really how I think about it. You have one, a time frame differential. Two, how is that interacting with the equity rotation? And three, where are we at with positioning? Because that's why it's hard to map these flows. You need to say, what is my rolling sensitivity of the equities to the curve, as well as these catalysts and these catalyst levels as well.
Yeah, that's such a good way to think about it. I really like the framing of the long end is pricing the mistakes or the good moves or whatever you want to call it of Fed policy. That really helps me think about it. So basically, right now, the long end is saying is testing the theory that like they're falling behind, and the scoreboard or the long duration like risk assets are going to have to shake out positioning, sentiment, euphoria, whatever, but it's kind of barricaded by these like deterministic levels almost of like CPI and all-time highs. So like all the stuff could shake out as the test is happening, the jabs, the crosses or whatever, and we're then going to kind of see where the chips actually fall. So like if we breach those levels, then it's pretty much that the long end was kind of correct in saying like, okay, maybe this is actually more of a concern than we're thinking. But if they don't, and we go make an all-time high from these levels, then it's basically showing how resilient the market is, and that the long end's testing with the bear steepening is actually, it was just like, no, they got to pull back and reassess. Is that like a good way to think about it?
Yeah, 100%. Yeah.
Okay.
I think that's really good, because then you're just not trying to overcomplicate the distribution of probabilities, right? Because I think a lot of people are always looking for, where is the certain outcome? Nothing, where is the thing that has to happen no matter what? Where in reality, we're always thinking, well, there's 3 probabilities here. We're at the extreme side of one of them. Let me just take the other side of this, because I think at the very least in this time frame, we're going to revert back down. And if that continues to get confirmed, I'll hold the position. And then if it doesn't, I'll get stopped out because I have a really clearly defined risk reward. But if you say that to someone, they all they hear is, so we don't know what's happening.
Right. And, between that 7,400 and 7,600 ish level, or maybe even a little wider than that, a lot of people are staring at those candles as if those are the answers. And what I'm seeing here is that this is all the shakeout of all the noise, all the positioning, all the vol, right? The vol was up, vol was down. Like, yeah, this range is almost the part that like you really don't want to look at in a way.
Totally. Well, and it's also just kind of funny that you're like, let me pull this up. This is
real quick. Sorry, while you're doing that, if we were to push even lower into that bid zone, that would, funny enough, it will line up with, I'm sure, everybody getting absolutely bear hold really hard if we go back down to those levels, and they're gonna kind of assume that it is conferred wrong, but that would ironically be maybe one of the better areas to add to positions or whatever, if your base case is that we're in a credit cycle melt up and things should normalize. I
agree. I think that the fact that we have, we're up 16% and now we're down 1.3 is like, it tells you everything that you need to know. And this goes back to your point that you shared in a video this past week, which is, well, how are you thinking about things at these different levels? Because now for me, right, like, and this just goes back to operating from a position of strength. We already have trades that are on sides, right? We have the luxury of saying like, okay, well, if things change a little bit, I can add to a position when I think we're going to make a short-term bottom. Or if we start to unwind and things start to really show different evidence of what we had in our original thesis, then I can still take off my risk and I'm still way in the money. And I think that's again another thing where if you execute at extremes and when it's actually aligned with the risk reward, then when you get to moments like this where you're saying, okay, there could be a short-term pullback, but I want to be long-term bullish, but I want to wait for further confirmation, so I'm not going to do anything with my position, right? Those are the little things that really stack up. And that really helps trading across multiple time horizons. That's why it's valuable, because if you're just coming in and trading intraday every single day, then you really have less of the luxury to stack these wins on a higher time horizon and ride winners.
Right. And we just talked about this idea that if you come in and spend every day doing this, that your job effectively, if you're making big bets, like, you know, in this case to the long side, your whole job is to come in and to decide, do I hold or do I sell? I guess, or do I add? Right. But if
Right.
you had established your cost basis a lot lower, you had the regime figured out, you stuck to a good positioning metric. Now, when you're experiencing this moment, we're able to think a little bit more clearly through this. And then you can decide that day, well, no, I mean, this my job says to hold today.
Yeah. Agreed. Other good question here on, you focus a lot on liquidity and positioning, but do you also take into account other variables? For example, I believe Trump is trying to reshore manufacturing. Do you use tariffs for that? He also needs the lower value of the dollar, hence lowering rates. However, he has to make sure the dollar stays intact as a global reserve currency. The best way is control oil and make sure petrodollars stay intact. By the way, I don't really believe in petrodollars. I think it's a little bit of a misnomer personally. So when politicians have such plans that can influence macro, do you also take that into consideration? Yeah, 100%. I mean, if you've followed any of the research that I've done, you know about how I'm thinking about that on a global basis, the global geopolitics. We just did a video earlier this week on the impossible trinity. And if you don't know what the impossible trinity is, it's about to get a lot of fun, because if you want to connect those exact ideas to how things function, go to the Capital Flows YouTube channel, go to the live section. By the way, you guys should just send this live section to everyone that you know. Just a good idea. Go to the impossible trinity behind the melt up, and then also go to the FX drivers, AI flows, sector flows. I cover those large factors in these two live streams. And so what I would encourage you to do is go through those, spend time thinking through them, go onto the website at capitalflowsresearch.com, go through all the slide decks that are in that as well. So if you go to capitalflowsresearch.com, go to the archive and go to the section down here on the impossible trinity, you can download the entire slide deck for those two things as well. So I would encourage you to go through those things, and they have a comprehensive breakdown of everything that's happening.
Also, I mean, it ties right into all of your Warsh and Besant stuff that you've put out too, and you've done some live streams on that. Because if you could start to have your own reads on who they are as a person, why they might have been put into the Fed seat, how they're going to shape policy moving forward, it ties into the whole geopolitical factor as well. And you've done plenty of stuff on that I think would be really good for anybody interested. And I know we don't ask enough, but please, if you are on X or you are on YouTube or something, like just click the repost button or whatever. We want to get more people on the live stream. We want to get more questions, and we want to provide more value. That's all we're trying to do here. So if you don't mind, just take 5 seconds to do that. That'd be awesome.
Here's another question. I think this goes back to this entire idea of people talking about the petrodollar system. Petrodollars are not intact. Saudi Arabia is selling oil in yuan already. They're banking on dollar swaps and stablecoins. That's just totally false. They literally have their currency pegged to the dollar. They're literally, their entire system and balance of payments is pegged to the US dollar. So maybe if they transact in yuans a little bit, like 1 or 2%, for invoicing reasons, or because they're like stabilizing something or just managing some assets and liabilities, yeah, sure, maybe. But when people put out these narratives or articles of, people are starting to transact in bricks or this or that or this currency or that currency. They're trying to create one. It's all just FUD. The United States is the global reserve currency, and everyone wants that. Every other country wants dollars. They want to use dollars because if they do that, that allows them to export their stuff to the United States. They want that. It's like if you have a company and your largest contract is with the US government, you're not going to say like, "Oh, we really need to stop depending on the US government." You're going to say, "How can we make as much money as humanly possible?" And so this entire idea that we're beginning to shift or the US is trying to do X, Y, or Z with the the political system, the dollar's reserve currency status has more to do with, it can't just disappear overnight. And it would really require so much, not even just with the Fed, because even though the Fed is they'll increase liquidity or print money or whatever you want to call it, that didn't even change it. The global trade actually increased. So, again, it just comes to people that are not understanding how global trade works and why countries, every other country out there wants, you talk to other people in other countries, maybe not Europe. Let's not get started on Europe, but like every other person, they want to come to the United States. Every other person. And so I just think it's so critical to understand that.
And I don't get what it is with like, the narratives feed off this idea that like the U.S. hegemony needs to fall. Everybody just wants to see it fall. And what sucks to me as like a proud American is like seeing Americans want it to fall. You know what I mean? Yeah. And a lot of it comes down to monetary policy, and maybe they're kind of not part of the upper K and they feel like they've been wronged. So they want to see it all burned to the ground. So then you see an article about, oh, look at this. China has made the BRICS nations and they're taking pictures and they're all going to turn to gold and the yuan, and America is the Roman Empire and they're falling apart. And I love it. And I just like, I don't know, it goes back to poker for me where it's like, if you can't spot the fish at the table, like you are the fish, man. If you're buying into these doomer articles because deep down you really want to see it happen, I just think that's like not the best way to approach markets. And I'm not necessarily calling out this guy. I'm just saying that to me is a good example. Or like the Iranian 200-foot subsea cables like thing where Patrick Bet David was on his podcast saying, "Did you guys see what's going on in Iran? They're sending out teams to go cut the cable. You know what happens if they cut the cables? 25% of the world is going to lose power to the internet. Do you know what will happen? The streets will go crazy. The revolutions, and I'm just like, dude, what are we doing here? What are we doing?"
I think it goes back to, I think this bigger picture idea of like understanding the structural forces helps you understand the environment that we're in. Because, just to be clear, ever since Trump got elected in his second term, U.S. hegemony and dominance in the world has only increased. And the probability of it continuing has only increased. So when you look out there and you see, I don't care what people say. I know there's issues here and there. No president's perfect. Whatever, man. You literally have a powerhouse of people with Trump and Bessent and Warsh and all of these guys, Howard Lutnick, and you're like, oh, well, these guys like are from the financial industries. They're like, they're the guys that have aggressively run money for years. Exactly. Like, that's the point. You're like, oh, that, they've been, so aggressive in all of their things in markets, or they've done this, and that. Exactly. We want them to be on the other side of the trade that another country tries to take. Because who do you think is going to win? We're going to win. And so I just think that it's so hard for people to look past the, even if they're like, oh, I wouldn't want to have dinner with that person or talk with it, whatever. U.S. dominance is increasing, and it's not going away.
USA. No, just kidding. Bring up the S&P 500 and put it on like a monthly chart. I want to just show you guys. You could spend 6 months, 2 years, 5 years, 10 years, trying to be Michael Burry. And look what you're missing. The scoreboard is right in front of you. And like as like the slop and the propaganda just keeps going, and you get KOLs and all these things talking about this is going to matter the most. There's no possible way interest rates could go above 3% without this debt-ridden system falling apart. Do you know how many trillions of dollars in debt America is? Do you know how many credit card delinquencies are happening and how many mortgages, blah, 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 blah. Scoreboard. I don't know. Come on.
All right. Let's keep going, guys. We can talk about America. Obviously, we're both patriots. You know, we think it's the greatest country in the world. That's why we live here. All right. When does the long end start to cause issues? Still below nominal GDP growth of 5.6. Does that mean it's not an issue yet if equities cause growth and yields? Basically, here's the idea. Once higher rates impact the equity risk curve, then it'll begin to happen. When you have, this goes to what I covered yesterday, when you have small caps rallying the way that they are and capital moving out the risk curve, then those are going to be the things that fall first. And, you know, let's just look at 2021 for a second. And it's not going to be ARK this time, but just look at this. This looks like a meme coin. You know, when we had the ARK ETF, it was the main thing that was the highest beta play. If you want to say what's the high beta play now, you just screen whatever high beta names exist and separate them by factor, and then you can kind of know where the big flows are going. It's not into ARK anymore. Notice that ARK here outperforms on the upside in the final melt off that it has when real rates made its low, dollar made its low, everything like that. Outperforms the S&P. And then notice, as soon as 10-year rates begin to rise, what happens? It impacts ARK first. And then ARK makes another low. And notice that as these take place, you have pullbacks in the S&P, pullbacks in the S&P, pullbacks in the S&P, pullbacks in the S&P. And then ARK starts to make a low. Why? Because it is beginning to feel the higher real rates, higher nominal rates. And it begins to be in this range and not make a new high. That leads, because it has higher sensitivity, the entire S&P 500 bear market in 2022. And so this is why you want to watch capital moving out the risk curve. Now, here's the thing. ARK is not doing the same thing this time because they have a very different role in the system because they're not as high a beta play. And so you want to watch different signals this time and different sectors that are higher beta because, you know, ARK is still at these levels. I think there's, is this it? Yeah. I would be watching this ETF by ARK, the ARKQ ETF, because it's been the entire technology and robotics ETF that's been making new highs over and over. And I would say if we start seeing rates rise and then we see ARK ETF, the ARKQ ETF, start breaking these levels, and we start seeing cross-asset shift, we see some other issues, then yes, you want to begin to say, okay, let me start watching that more closely and have a closer eye on that. So that's what I would say about that.
Back on that chart that you had here where you were overlaying the 10-year.
Yep.
On the S&P or whatever, during that period where you had that spike up in 10-year yields, prior to that, the 10-year was creeping up, yet everything was melting up. Yeah. Yep. So like that zone right there, that's what I think is really interesting as we're moving into. And I was going to ask you, what were the real rates doing during that kind of slow bleed up, not that final crescendo?
Oh yeah. So like this slow bleed,
yeah,
kind of ironic because what happened, this is 2021. What happened during that period of time? 1 year real rates were, guess what? Negative. And you had the long end real rates. Here, I'll show you right here. 1 year real rates during this period of time were basically negative. And me see if I can. Yeah, so right here in 2021, this is when it was happening. 1-year real rates were negative. 30-year real rates were beginning to tick up already. And so they were actually negative too. Real rates for the 30-year bonds, you actually lost money if you bought 30-year bonds just in yield form in 2021. So this is, kind of the idea where, sure, 30-year reals, they were negative during this period of time a little bit, and then they started to tick up. And notice, let's see, this is going to be an extreme chart. Let's find it. 1s, 30s. Notice in 2021, here is the 1s, 30s yield curve. So 1s, 30s began to steepen, where 30-year real yields were rising faster than, and basically pricing the policy error. This is the market pricing the policy error during that period of time. Now, this was just us repricing growth, and now we're beginning to tick up a little bit more, but we're not at the point yet. If the Fed started to bring hikes on the table and actually realize those, that would begin to be an issue. But right now, we're in a period of time where if a hike gets priced, the Fed fading that is likely to set lows in the S&P, whether it's a 2% pullback or 1% pullback or 5% pullback or something like that. So that's how I would think about the real rate kind of dynamic.
Okay, so that's just really interesting. The 1s, 30s, like, it was kind of starting to move up as that move was happening, and it kind of got to a point where it broke off the top, but we're not anywhere near.
We're not there yet,
and we're like kind of a flip, right? In just the overall rate situation where we have like a lot of they're not being boxed into a corner as much.
Exactly. And then here's what I would say too. This is why I'll talk about, we have an impulse, but it's sowing the seeds of its own demise, because we do have a liquidity impulse, but it's not going to last forever, because again, we have this tenor issue where short-term liquidity is being injected, but the long end is being like, oh yeah, this is not going to last forever. What is that? I mean, again, going back to 2021, that melt up lasted for a year, right? And then you had some pullbacks and 6 months and stuff like that. So what's the timing? The timing has more to do with how long the Fed and the system, the Fed remains inactive into a resilient system. If the system becomes less resilient, or if the Fed begins to act, that's going to set the top, as opposed to like people are like, oh, it's going to be September. Like, you don't know that. None of us do. What you look at is the extremes of pricing in the forward curve and in rates, and then connect that to how aggressively each agent in the economy is taking action, the Fed or consumers or whatever that might be. And that's the entire key, because if you're just saying like, oh, well, it's going to be in September or October, or like, I don't know, what are the other months in the year? I don't even know. People are coming up with all these like just arbitrary things. And I just think like, go ahead, look at those, because you're not looking at where the puck is going to go. You're like distracted. And now you're anchoring to this artificial timeline that has no relevance, and you're not looking at the actual ball. And so I just think it's great, because like that's why people get off sides, because they're like, oh, we can't go any higher because of this, and this, or we can't go any lower because of this, and this arbitrary month, seasonality, blah, blah, blah. Like, insert whatever arbitrary thing that you heard once on a podcast when, you weren't really like asking hard questions, right? So I just think that the highest quality ideas will remain resilient under the greatest scrutiny, and you should just be asking a ton of questions, which is why you should be asking questions in the chat right now and beginning to refine the thesis that you have.
Also, what's interesting to me, just to finish that thought off, is that in 2021, I could almost buy it a little bit more, because like there wasn't this like massive technological world-changing shift happening, right? It was like weird short squeezes, crypto, NFTs, like whatever. And now we're having this like AI revolution. And I'm like, if you add that in and you give a 2021 vibe to it, like it just, to me, pours so much kerosene on the potential melt up that 2021 almost didn't even have. Like we were almost trying to create something out of nothing with pixelated art and, different things. or GameStop or whatever. And now there's like hundreds of companies that value could just like fly into.
Totally. Yeah. 100%. I think this is, I did the entire video on this. Again, show up to the live stream, guys. Or, it's funny. I love when people message me and they'll talk to me and they'll say, I've gone through every single one of your articles. I'm like, wow, okay. I'm like,
Lies.
I'll hop on a call with you, sure. Like that's because I'm just like, that's what I'm like talking about, or it could be anyone else, right? Or I read through all these books. That's awesome, right? Because that's how you're going to build an edge, right? I remember, like what I would do sometimes, especially when I was like learning a lot, is like I would read some research reports and I would go through and I would say, like, here's all the ideas that they had. And I would just try to pick out what are the underlying principles and logic they would use to come to that conclusion. And I would literally write them down and I would have a Word doc that was like 20 pages long. And then I would go through that entire Word doc and build models and do research around every single idea. And then say like, okay, is this idea good? Is it bad? Does it only work sometimes, not others? Why did they say that? How can I think about that? And that's how I would go through research instead of just kind of reading through it and be like, okay, interesting view. Let's move on. I would just say like, how can I derive a view that I can learn something from this every single time? And bringing it back to where we're at right now, the entire idea that I laid out this past week and then last week is that in 2021, the melt up was primarily monetary. So when we had that move in the S&P 500 and all this tech stuff, it was primarily a monetary impulse. And we had a lot of other things connected to it as well, right? We had all the Web3 stuff coming out. We had a lot of crypto stuff. We had a lot of new SaaS products. We had a lot of new goods after the whole work from home thing. But the primary catalyst was monetary drivers. Now we have a monetary driver, but we also have an AI driver. And so this goes back to the entire thread that I've laid out on the credit cycle, which is all about how do you connect the AI side with the monetary side and the AI side with macro liquidity. And I laid all that out in this credit cycle thread right here. If you're saying like, oh, I haven't gone through this thread, then just go through this entire thread right here. It's on the website. I'll retweet it right now. It's published on, May 12th. Here. Go to the Twitter page and go through all of that yourself right now. And this entire credit cycle melt up talks about that. And I've laid out all the resources for how to think about that as well. So you can go through all of those things on the website. And the idea is that AI is a monetary impulse very similar to how the monetary side was in 2021, which is why we're seeing some comparable things. I think this is a good question as well. Thoughts on SVG, MSFT, Microsoft, ServiceNow? Do you think we pull back a bit heading into May and sell in May comes true? Guys, I reject this entire idea of sell in May. Just don't. We're not going to talk about it. It's just an arbitrary.
It's already
idea.
May 15th.
Yeah, I'm just like
it's almost over.
So what I would say is on Microsoft, I think Microsoft is going to do great here. I think it's going to lead the entire rally in IGV. Here's what I would say about ServiceNow. Now, ServiceNow has been, they've prioritized buybacks and integration over CapEx, which is why there was this, there was a long short trade for a while in Now and Oracle, and that's kind of come off now. I like Oracle over ServiceNow because they have all the CapEx that they've already done. All this negative pricing was them repricing their CapEx. Now they're going to experience the upside of all the CapEx that they had. I think they're just going to do incredibly well. My view is that Oracle is going to hit $340 sometime this year or beginning of next year. I think this year. We'll see what happens. I own calls. I've laid that out in the Substack. If you're not going through all of that, go through the chat, go through all the stuff that I'm laying out on there. I've laid out the Oracle thesis. Just go search it on the Substack. So my view is that I think IGV it will rally, but again, the equity long short trade. I mean, you can see this. Look at how IGV today, they're up, but the S&P is down. Why? Because SMH down, tech is down, right? But you know, tech is basically flat now, but we're down in the day. This is equity long short positioning. People that were short IGV and long SMH or tech, right? They're now having to unwind both sides of that trade because they don't want to take the directional risk. They need to stay market neutral. So all these pods and the equity long short guys are now having to unwind their positioning. So that's what's taking place right there. Couple other questions. Still have conviction on gold. Oops, hang on. Let me pull that up. Yes. Come on. Pull this up. Now we're positive on the day now in Hyperliquid. Imagine that. PERS still down 3%. That sounds like an opportunity to me. All right, gold. Here's what happened with gold. We had this melt up where call skew blew out. And the fact that call skew blew out set the stage for the upside. That shows you where that to make a new high, you need a durable catalyst because this was such an extreme in positioning. Then you had obviously the unwind of call skew, and then you had the unwind because it wasn't bidding from geopolitical risk. We actually covered this in real time. James and I were talking about this on the live stream, like over and over. I was basically like, oh, we didn't bid from geopolitical risk. We're probably going to flush down, wick it, and then, you know, make a bottom. And then in this area, I talked about being long gold. I had some longs that I was running, and we've kind of come on sides. We pulled back. Now we're at these levels. My view is we'll probably stay above here, but my bias is that the driver of this has been the stronger dollar side because gold has really been a derivative of the dollar here, and the dollar has moved. I'll just invert the DXY. Notice that the DXY has been moving in lockstep with gold here. So that tells you a lot. And so the DXY driver has been this rate side in the United States. And this is a clear expression of real rates, right? So if you think real rates are going higher, you probably want to, well, here's the thing. I've talked about this as well. I like being long gold and short bonds because gold is probably going to outperform bonds here. So once bonds have any type of capitulation, and remember, this is the FOMC level we were at in gold. So this was FOMC right here. So we're still back at that level. And so my view is that gold I'm looking for us to remain above these levels right here, but I really want to see us move through some catalysts and it diverge from bonds. If it diverges from bonds and the dollar begins to weaken a little bit more, remember the DXY here is inverted. So the DXY weakens. That will be when you have a little bit more of a low set and some more upward price action, which is what we had in silver, but now we kind of unwinding that because silver outperformed gold for a little while. And then, you saw this entire move up, and now it's just reverting back to a more of an extreme, but we're still holding these same levels. So I'm not really surprised. Copper, basically same dynamic. It's outperforming a little bit more. Palladium and platinum, I think, are going to be interesting. They've been underperforming. So that's how I'm viewing the positioning right now.
Yeah, I'm gonna just pull up my silver chart here because I think this is a really interesting, confluence of things, right? Like you have this massive shakeout. You have a almost 10% down day in silver, right? And then if you look at this, just like daily silver chart. Honestly, to me, this is like one of those spots where I'm like, if I'm a silver bull here, if I think real rates are going to continue to go lower, if I think silver has, if I built up my silver thesis to where I'm bullish silver moving forward here, and I'm looking for an asymmetric bet in a spot where volatility is probably it's maybe giving me an opportunity to get into a sneaky position where a lot of people are kind of hands off now. Like this is the type of thing I look for. Like I look at this chart. Like the chart is great, but like with this whole backdrop, if you have a lot of conviction in silver, I mean, I am frothing at the mouth at this spot right here because the risk reward seems so good. Like you have just this giant range here. I guess I could just do a little like you have this giant like area where there's just been a ton of volume traded over time, right? And if you're just like looking at this from a dumb person's perspective, like a dumb chart 101, like this just looks like an amazing spot to me. Because a lot of people, what they're going to wait for is reconfirmation for it to go like, they're going to want to see this. They're going to want to see, then maybe they'll get interested here, right? But this goes back to our whole idea of like taking trades at extremes based on your thesis, your bias, your convictions, to where once you get up here, you're going to be in such a clear space mentally and able to make great decisions, able to hold, able to like expand and compound on that winner if it works out. And, you know, I'm not saying you need to get into silver now, but if I was looking for it, I'm like, this is one of those juicy days where I'm kind of like backing up the truck, right? I've traded commodities a long time. Seeing 10% down days are pretty rare, you know? So I don't know, just some food for thought. I guess I don't know if you're still there. You might be muted, but I'll look at the big. I haven't looked at the silver gold chart, by the way. Where is it here? So we had this extreme move up where silver was outperforming gold for a while, and if you look back historically, I remember looking at this. It's kind of crazy. Yeah. So this previous run here. On the monthly chart. I mean, this is going back to 2011, 98, right? So you could see something historic come if silver were to go and make another high and break this range and outperform gold too. But just something you ought to keep an eye at if you're kind of like playing in the metals space. Metals are hard, man. They're hard. But they could be some of the juiciest spots that you could find out there. And man, silver just looks interesting today.
I think the cool thing about the metals complex is that it is the most trending part of like inflation and liquidity, because I think this is why like Paul Tudor Jones did so well, and like when you have inflationary spikes, it's so insane because interest rates and bonds and SOFR are such precise instruments, right? And there's so many ways to arbitrage them and price them with efficiency with just such extreme precision. Whereas like gold and silver and metals and copper and all this other stuff, it can just trend for a long time, right? That's why I think that like Paul Tudor Jones and all those guys who were around in the 70s and 80s, right? They just traded 2022 so well because they're just like, oh, inflationary cycle. We haven't seen this in the 70s. I know how this works. They just knew it, right? And I think that's like one of the coolest things about having that type of experience, right? You're muted.
I agree. And obviously this is noisy, but like you just lay all the metals on top of each other and you could start to create a story, right?
Yeah.
I mean, I don't know. Some of this stuff could get real wonky. And you could even see that rare earths play come back. You know, everybody was talking about rare earths for a while. What's that company? Is it USAR? USAR maybe? Nobody's been talking about this for a while.
What are they again?
This is the United States Rare Earths, whatever. It's the one that like the Trump administration basically, I don't know if they took a 10% stake in or something like that, but there was a really loud time for that, right? And it's, again, actually look at this chart and I'm kind of like, ooh, this looks spicy, right? Like I kind of like these relevant but forgotten things, you know, because hey, if you get in here, maybe you can find some really spicy lower volatility call options for 2028, right? When nobody's really talking about it. You can set risk rewards for yourself for whatever that may be. You might size correctly. This thing gets back over $32 and you have like any interesting kind of China, rare earths, blah, 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 tariffs, Trump, whatever. Like all of a sudden you're going to find yourself in a like really lucrative position. So if you have the metals complex, the rare earths, I mean, somebody mentioned like chemicals, whatever. These types of, this is how I start to think through like looking for opportunities where maybe other people are like, while they're busy chasing like whatever the 5-layer cake AI build out thing is right now, that's already moved 60% in the last month. Something like this kind of starts to interest me.
Yeah, totally agree. I think it just goes back to asymmetry and finding the best expression. And I think that's where metals really come into play, especially if we have some type of risk off move or some type of change in real rates. It's just going to be on the upside and downside are going to be so interesting. Wanted to go over this other question here. How do credit spreads weigh into risk for capital rotating out the curve and things like that? When, triple C OIS has ticked up recently. All you want to do is go to the video that I just did this past week on the risk curve and money, because I covered this. Basically, credit spreads are pricing very similar to what equities are on the equity risk curve. So, credit spreads are functionally a different part of the capital stack than equities, but they're very similar, like very, very similar. Both of them are inputs into each other when you're pricing them. So I would say it falls in line with the entire credit cycle that we've been talking about this kind of entire time and the risk curve, because if delinquencies start to happen, where's it going to be reflected first? Triple C, triple B, and then it'll hit investment grade. So that's what I think. On a couple other questions here. Do you have any other big bets? I am working on them, but the timing is off, so I'm just waiting. But yeah, I have a couple other big bets I'm cooking up, but there are a lot of there's so many opportunities. No single person can get all of them. So I would just say that you have so much opportunity if you find some type of niche in a company with chemicals or batteries or whatever it might be. So I do think that there is a lot of potential for that. Here's another question about earlier. Pointing out Saudi Arabia selling oil in yuan is not saying the U.S. is going to lose reserve currency status. The problem with your question is that this goes back to you're just buying into this entire narrative that it's shifting because it's such a their entire currency is pegged to the dollar. Like, I don't think you understand what that means, where they are all cross collateralized with dollars, and the yuan purchases or transactions is such a small percentage that it's functionally irrelevant. So again, you just don't want to conflate those things. But that change in oil pricing is a change in marginal demand. Not really. It's just about transactions and how you're balancing the capital account of things. As long as the dollar is pegged to for Saudi Arabia is pegging their currency to the dollar, that kind of idea that, we're transacting 1% in yuans is basically irrelevant. It's just noise. All right. Any thoughts on Tesla as an AI and infrastructure play? So, James, maybe pull up that chart. I think that the Tesla side is going to be interesting because we have the SpaceX IPO this year. And I think that's going to be the most interesting thing as you want to watch the SpaceX IPO. Actually, we should do this on Hyperliquid and overlay both. Can we do that, James? Pretty easily, where we overlay SpaceX and Tesla on Hyperliquid?
I don't think you could overlay stuff out of Hyperliquid's like charting softwares, if that's what you're saying.
That's what I'm trying to see if we can do that.
I would bring up Hyperliquid, but that wouldn't be a good idea right now for me. So
why?
I would have to.
Oh yeah. I can pull it up.
Yeah. Not that I use Hyperliquid, but yeah.
And I was like, wait, what's wrong?
Why are you laughing, dude? I gotta try every time I want to use it. I gotta take
website. I was like, why are we pulling up?
Dude, I would have to take I've been going to France recently just to trade on Hyperliquid. It's nuts.
There has to be, what is this, December? Okay, year to date. Here's the SpaceX year to date pricing. And year to date, I actually think we're down in Tesla.
Yeah, but that's just because they barely made an all-time high right before the end of the year.
Yeah. Yeah. So I think that this is going to be something important to watch. So we have this move down, short-term rally, move down again, and then when you look at the Hyperliquid, move up in SpaceX, kind of a little bit move higher, recent move higher. So I'm just watching this because I think that this is going to determine a lot of flows, just in positioning, and I'm really interested to see how that functions. So I don't know how that's all going to play out, but I think for SpaceX and Tesla, it's more about the pricing relative to fundamentals because we already know that all the stuff that they're doing is amazing. That we already know that's happening. The question is, how is that going to function as it relates to positioning? So I think that'll be kind of the key thing that we watch the most.
Speaking of that real quick, just your thoughts on like SpaceX, I guess would OpenAI to like if you combine like the onslaught of these bigger or Anthropic maybe, you're speaking in the terms of like $5 to $10 trillion of like quote unquote supply coming onto the market. What are your thoughts in general on that being an issue or not an issue?
Wait, sorry, what?
Like the market has to kind of absorb large IPOs, right? Like
right. Yeah.
I just wondering what your thought is on that, and if you foresee that being an issue or not really.
So two things. One is Musk is trying to get SpaceX added to the S&P 500 on day one. So if that happens, passive flows are going to come in and just bid the heck out of that. Large ETFs and index funds are going to have to like figure out how to cut a deal where they can buy shares. I guess either at market or whatever it might be, like day of or day before or whatever. They're going to have to like figure that out. It's not going to be easy. So they're going to have to, one, figure out if they're going to include it in the index right away, which is Musk is trying to do, which a lot of people don't like because it is creating, supply, or it's creating artificial demand. But I think the idea is that, yes, that is going to create supply into the market. I think it's going to be fine until liquidity shifts, because I think that a lot of people want exposure to all of this. I mean, this just goes back to like, I've talked to so many people who are early investors in SpaceX, and every single one of them says the same thing. It's pretty rich, but I'm never going to sell. Every single one of them. Right? Because they're just like, I don't want to not be long Elon Musk. I've already seen how that played out for Tesla shareholders who are like, oh, I took a gain, And so I think the idea is simply that, yes, it's going to create additional supply. We'll have to see how the market, absorbs that. I think that a market top comes down to macro more than it does a single company. I do think that eventually we'll look back. I don't know if it'll be like the Coinbase IPO where we haven't made a new high in Coinbase ever since it went IPO, where you can kind of see right here. Well, maybe we made a new high right here for a day. We made a new high for a day. Brian, what's not Johnson? Armstrong? Is it Armstrong?
Brian Armstrong, the bald man.
Brian Armstrong, Baldy. Hopefully he doesn't see this. We had this entire move down ever since the IPO, and we're still below that level. I don't try to like run these like templated scripts on like what's going to happen, but I wouldn't be surprised if like something similar like this happened with SpaceX. The problem is like the entire float, because if, let's say, I don't know how much Elon owns and institutional owns or whatever that might be, but if these guys own 80% of the float and then passive comes in and owns part of that as well, and 80% of the float is just taken offline and there's only 20%, then like it kind of doesn't matter. You could just have it keep going up just because there's an entire group of people that just refuse to sell regardless of valuation. So that's what I would say. It's really tough because there's so many moving parts. I think it's going to be interesting. I think Paul Tudor Jones had an interesting idea when he talked about that. So we'll see how that plays out.
Well, it'd only be fitting for a space stock to go to the moon.
Here we go with the dad jokes, guys.
Hey, real quick before you move on, you know what I was thinking? People who are good at puns, like it's kind of like, the running, the dad joke or whatever. But I actually think it's like it's a good trait for traders because you're able to like kind of quickly interpret two different things at once and put it together into something that actually makes sense. It's just a skill that you're never going to have, and it's something I'll always have that on you.
See, this is just like the projecting of like, I have a skill, so let me use that skill as like it's the only way that you can have enlightenment. Oh, by
I
the
have
way,
a course on this, by the way. Puns and trading,
there's I think a couple times in our entire relationship where I've like made a pun for people to know that I made a pun, and then you look at me and you're like, that was an accident, wasn't it?
You can always tell. I always know. Yeah.
And basically, I think almost every time I've actually done a pun, it has been an accident. Because I'm just not as bright as James. So
let's just say you're not as cultured. You know what I mean?
You know what?
You're not able to tie culture together in a meaningful moment in real time. And that's okay. That's okay. You have your thing, I have my thing. It's fine.
We all are special in our own ways, right?
Yeah. I wear a helmet when I walk around. You don't have
to. So, all right. What are your thoughts on the spike in rates today? Just rewind and you can go through all of it. We covered all of it already. New to the Substack, do you consider any short-term noise in your Oracle trade? This is actually a good question because people are saying, okay, if the Altman versus Musk trial doesn't go through, then there's going to be some type of issue. Here's the thing. OpenAI, Sam Altman might get rugged. Hopefully he does. I don't like him. I think he's like, I think he's incredibly intelligent. I think he's done an amazing job at like scaling everything at OpenAI. I think we've seen over and over that he's not to be trusted. And so I think that we'll see a reckoning for him someday, whether it's today or in the future. But regardless of that, whether Altman is in charge or not, or whoever owns OpenAI, it doesn't matter. They're going to still need the same amount of compute. And that's why they need Oracle. So it doesn't matter if and even if OpenAI begins to do, they're not going to collapse overnight or something like that. But even if they went bankrupt, all their models are still going to keep running. All that's going to happen is that all the equity is going to convert or basically go to zero and go to debt holders, and they're going to default, and new shareholders are going to come in and buy the debt and inject capital in, and they're just going to rerun the whole thing over again because there's so much IP in the company. It's not like, oh, well, we're not going to be able to go to chatgpt.com anymore if they go bankrupt. It's like, no. Like, that would be like, oh, if, Hertz is going bankrupt, so let's just throw all the cars away now. It's like, those are assets, right? Like, they're still going to use those. So I still think that the entire play works independent, because even if OpenAI doesn't use the compute, which they are, there's so many other people, whether Anthropic or whoever else, that are going to use it. So yes, this is very true. I don't make the rules. All right, thanks. Let's see. Good question here. Does rising and elevated oil jeopardize future AI CapEx financing if it pushes long-term interest rates? And conversely, if oil falls, does that change things? Basically, here's the idea. The returns on all the AI CapEx are so high and above and in excess of where interest rates are right now that the AI CapEx has entirely to do with the cash flow side, not the financing side, in my view. So sure, you want to watch that because credit's credit. But the entire thing is all about, is the AI CapEx going to bring cash flows as opposed to the financing? Because it's basically, if financing is going to be at like 8% or whatever it's going to be for the bonds or whatever it is, the bigger thing is less about if rates are going to go for financing from 8 to 9 or 10, and more about, are you going to make $1 billion or $50 billion, right? Like, that's the more important kind of question to be asking. All right.
By the way, if you guys have been here like all of the days this week for the live stream, throw that in the chat. I'd be really impressed to see if somebody showed up all 5 days. I think
Who's
this
been
was
here
one of the
every single
most,
day this week? Yeah, who's been here every single day?
I think it's been one of the most interesting weeks in markets in a while. We had big ups, big downs, big swings. The trades that we're in are moving. It's just good stuff.
All right. Here's interesting question. Do you use trailing stop losses for bets like per, Oracle, commodity, etc.? If yes, do you mind to explain how you set the range? If not, why? So here's what I would say about this, is that you should probably just go read some papers on like the quant finance space and how to set optimal stop levels from an academic and I think risk management perspective. Understand the trade-offs, and then you can know how to set them based on discretionary decision making. If you are someone who are saying like, I just want to do a trend following approach to things and not really think about that, then really just think about something like an ATR or rolling, moving average crossover, stuff like that. And if you're not trying to like connect it to fundamental information, you can kind of just see how a rolling stop works. But there's a lot of, this is like a very simplistic, not very optimized kind of section of how to think about that. What I want to do is transition a little bit, because James has, we can talk about this idea objectively of like, how do you optimally set a stop? But I think that's half of the picture. The other half is, what is the mindset side for that? And how do we integrate what your mindset should be and your discretion be as you kind of connect it to the stops that you're setting and how you kind of place those or manage those. So I'm going to have James pull up his screen right here. And let's talk about, not only from the objective side of like, how do we set stops, levels, edge around that, why certain levels exist even in the first place. Do you do a rolling stop? Do you take a risk, take a gain at the high? Or do you just, roll up your stops and just keep rolling them until they get hit? What are the trade-offs of that? How does that connect to who you are as a person? So James, why don't you break that down a little bit for us?
Yeah. So you mentioned a lot this idea on Twitter, especially. By the way, Twitter's just never fully rebranded. Like, it's been years now. Like, they've failed. It's still Twitter. On Twitter, you're always saying you get paid to hold risk. You get paid to hold risk. And like, intuitively, I was like, yeah, that makes sense. But I couldn't really understand it too much until I thought about it a little deeper, did some more research on it. And I just kind of wanted to talk a little bit more through that today, because I just think it makes more sense to me now. And I wanted to, if other people were kind of struggling to understand that theory, I wanted to talk through it. And especially since you'll be here today to add to kind of what I put together here, right? So the idea being that if you want a smooth return, you have options, right? Like you have money market funds or T-bills or whatever. If you're just a person who absolutely hates the idea of volatility, you want your cake and you want to eat it too, I guess you could kind of have that but you're going to get the lowest of the low returns. And as you start to expand out the risk curve, the premium that you can make for returns, the outperformance, the asymmetry you're trying to find, is going to be found alongside volatility. And the larger the volatility can get, the larger the premium can be, as well as the reflexive, like reversal nature of that too, which, you know, creates the hard to stomach roller coaster that is trading. So in a sense, like those smooth returns, like they don't really exist. Like the movement that you see on something like PER is a great example of it, is the reason that you can be up 100% on your position in, I mean, when did you put a position on? Is it 3 or 4 months now? I don't even remember when you put it on. Let's just say 3 or 4 months.
Year to date. Let's just say year to date.
Year to date, whatever, right? That's just something that's not possible if you want to eliminate the volatility and buy T-bills, right? You already kind of know what you're going to get. So that premium exists based on the ability for you to hold through that volatility as the network, as the growth of that asset moves through time. So you're going to have to accept that if you want to actually outperform, find edge, find asymmetry, and, you know, I could say go all the way to like living a better life, if you will, right? And this isn't just in markets. This is everywhere, right? If you want to never get sick, if you want to never interact with people, you can live in your bubble in your house and have that low volatility life. But in the end, you're not going to get the like premium that life offers by being able to go to an amazing concert or go out to dinner with amazing people or go on those trips to Europe or whatever it is. You know, it's all the same thing. Trading and life are the same thing. So our goal here at Capital Flows is to like map the macro regime so that you're able to find volatility premium in an asset, whatever that asset may be, that has that tailwind, right? With rates and credit and growth and volatility and the flows going and highly liquid or whatever. That's going to give you that go signal into something. In this case, it happens to be PER, right? Or in this case, it happens to be Oracle. It's just some of the things we've been talking about. Otherwise, if you're just holding something, it's stubbornness, like just dressed up as conviction, right? You could talk about us Bitcoiners as being some of these people sometimes where it's seeped into our identity to where even if everything points in the opposite direction, we really have a hard time hitting the sell button on Bitcoin, right? Because it's become entrenched in us. That could be seen as positive and negative, but just an interesting point. So we are often talking about how the entry is so important. I mean, when I stop for a second and you could just talk a little bit about how difficult it may be to put on a huge portion of your net worth into a hyperliquid treasury debt when it has not even, it's just gone down, right? So where you got in, you developed your thesis, you have your macro regime, you learn about hyperliquid, you understand the flows there, the regulations around it, and you are able to develop this like very cheap cost basis that is now paying dividends in the mental clarity that we discussed earlier when everybody else is still maybe even considering even getting exposed to that. So could you just run down a little bit of your experience as to what it was like? Like, let's just say this was PER, right? And what was it? $3.30 or whatever, roughly average price down here. And we're currently at like, whatever, 6.25 or something. Can you just run us through a little bit of what that was like for you to put on that position that really nobody else was talking about when it had only gone down?
Yeah, I think that when I looked at this entire setup that we had, and I started first kind of publishing reports on it here, and then all through this period of time. I actually distinctly remember this day right here because that's when I actually bought a ton, and I just thought, this is where technicals basically don't serve you because you break below this level and you just rip back up. I remember breaking below this level, and I just thought in my mind, like, these people have no clue what they're doing, or someone knows something that I don't know. But I was pretty sure that I knew that it was just all of the original sellers from the first deal getting out post-merger. And we were trading at such a massive discount to the underlying token. And it's also one of those things where you feel a little bit more comfortable just when you have a chart like this, you probably feel more comfortable buying a dip here or here than you do like when there's just no chart, right? When there's just like, well, what's here? Nothing, right? Like we're only below highs and all the volume that went through. So I think a lot of it was you don't really see a lot of times it's nice to look at the long-term Apple chart and be like, oh, well, okay, over time it goes up and to the right. And then you see this and you say, well, it's only gone down, right? And so I think that's definitely a part of it too. But in my mind, if I am convinced about something, I always want to, have the redundancy plan. But if I know why things are happening and I say this is happening because of this, and this is happening because of this, then that's how I build conviction. And for me at least, I don't build conviction based off of sentiment itself. I mean, I was monitoring sentiment this entire time. By the way, during this entire time, I posted so many charts about this. Basically, during this entire circle in this period of time, there was functionally zero mentions of PER on any website, Twitter, or anything. There wasn't even mentions of hyperliquid, but much less PER. And even when I started sharing about it, I was the only one that was talking about it. And so I think that the mindset I had during that time is that I rarely ever take a massive bet unless I have such high conviction. And I think, when you're in that moment in time, I think you just see everything really clearly and it doesn't feel like whatever the gambling addicts are thinking online or something like that. It didn't feel like a gamble to me. It just felt really clear.
Yeah, that's the thing that all of your work leads to, right? Is the people that have made the biggest returns in the world have often taken these bets that nobody would even consider, were probably really hard to stomach, and like nobody's talking about it. But like if you're thinking about who is going to deserve the most premium in the end, who is going to deserve the most returns, it only makes sense that it was the person that was willing to take, not only have that conviction and take that bet at the start, right? You over here, but you were able to hold through everything, right? And kind of, the whole like graceful exit thing is something down the road we'll probably dive more into, which is just as hard as the entry. But like,
Right.
my point is, as the price started to move up and make more relevance, you'd have all these people right here thinking, okay, I'm going to buy now. And then there's a pullback and they're like, wait a second, did I just make the wrong decision? Then they're going to do it again here. Then they're going to question everything here. Then it goes, they partner with Trade XYZ and people buy it here. Then it pulls, you know what I mean? Like the importance of this zone and conviction and your ability now creates what's called the buffer for you to deal with all of this in a way that none of these guys can deal with it.
Right.
You know what I mean? Like it's not possible for them to go through the same experience of the trade now, right?
Right.
They're gonna have to have their own story that was created from where they entered. Same with you guys. If you're out there in the comments and maybe you have a little exposure to PER or whatever, like there's no way that most of you were, unless you're a paid subscriber, were really going after it where he was, right? You might have come in the recent weeks, you might have seen PER, you might have seen all the tweets, whatever, and you're going to be kind of interested maybe, or looking at it for the first time somewhere in this range, over here, and having to make your own decision. And it could still be a great trade, right? But like the whole point of this kind of slide deck is like, Flows is getting paid the premium of the risk he took back here. And all of the movement is generating more and more and more premium that, if it works out in an asymmetric fashion, since he's willing to hold, will all redirect the value back to the people that were able to do that. And that's literally like what we're trying to do here, right? Map the macro regime, whittle it down into some asymmetric fat bet and holding it, and I just think that's super cool, to be honest. And here's that kind of asymmetric structure, right? That like you're going to get paid a lot more of that premium if you are able to kind of cozy into some of these spaces down here, right? Down here, all of that is going to be allocated towards you. Whereas like the people in Apple who think, oh, thank God, this thing has had so much history. It goes up and to the right. I could trust to put my retirement money in there. You know, that's going to be when they've hit the top end of that kind of network growth. The volatility has been dampened on it. There's all these financial products and options and all that stuff. And the returns for them are going to be sucked out. And you know who got them all? All the people in Apple who are like, oh my God, the iPhone. And nobody believed in the iPhone. And the iPhone wasn't going to work. And they were just stomaching that risk. And guess what? You know, same with Tesla, same with Bitcoin early on. It's all that conviction and thesis building back here and where they got paid off. It was not luck. Sure, a little bit of it was luck, of course, but it was all the planning, all the stomaching of the volatility that led to them getting to munch on the premium that comes along with it.
Can I add something to that?
Yeah, sure.
I think that going back to like the Apple analogy, people realize at the time, everyone was arguing like, well, is it going to be Apple or Nokia? And there's like good arguments on both sides. And everyone's like, well, the analysts say this, and then they say this, and then they say this, right? And there's a divergence and misperception around it, which is actually goes to one of these comments where someone, said, first time I saw you sharing the per chart, I thought he was, sharing a shitcoin. And that, and then no one liked crypto either. And that's exactly why I was like, oh, this is so great. Because everyone I talk to, what do they say? Oh, no, crypto's dead. And then also DATs are worthless now because we just went through all the Bitcoin DATs. And crypto is all about pump and dumps or stuff like this. And I was like, oh, no one understands this. Everyone has kind of just written all of this off. And they don't understand, no one, a lot of people in crypto have never even understood what it means to create value or cash flow because they've never done that in the first place. All they've thought about is like, how can we dump our bags, right? And so when I see something that's fundamentally different, which is why I published a bunch of reports on it, right? And I think one of the ones that I published that was just so critical. Let me find this one right here. It's they sold everyone a lie and then became the new establishment. This is where I just went through and I was like, no one is really getting this because it is everyone in the industry has just kind of become an influencer and sold narratives and not created value. And then you have Hyperliquid coming out and shifting the entire thing. And they're saying like, oh, well, we don't need to do marketing. You're like, wait, what? You don't need to do marketing? Since when? What project ever needed that, took that stance? And immediately when you see that, you're like, oh, there has to be something bigger here. But people didn't want to think about that. They just kind of wrote it off. That was one of the reasons why it wasn't just about the project itself, but it was about the divergences that took place where everyone was thinking about it as well.
On that point, I think I've learned in recent years to be a lot more open-minded to things. Like I'm usually quick to judge and we're so quick to shift and whatever. But there's been so many times I look back and I'm like, man, somebody wanted to have a conversation about that with me and I just wrote it off, because this and this happened. And I just said, nope. And I think this is a great example of that, especially after like the Bitcoin treasury DATs, like we're just getting absolutely manhandled. Right. But yeah, so really good stuff. So our boy Jared Cuban too talked a little bit about this, and I was mentioning how I thought it was such a great framing here. Is like a lot of us will get caught adding to our losers because we have this emotional debt that we need to fulfill from like a loser, like especially if we are like really convicted on something. We don't want to admit that we're wrong. So like if we're down and we're off sides, we're going to be adding to that position to like make us feel better again. Almost like I'm averaging it. I'm showing more conviction. Look at me. I'm believing. But in reality, that position has been not rewarding you. It has been acting poorly, yet we're rewarding it with more capital. And his whole reframe is that what you should be doing is you should reward the positions that are working for you with more capital. Make your positions earn fresh capital. And I just think that's you talk about adding to winners all the time. I think that reframe for me has been huge. Like I'm just so done trying to add to things that are hurting me and trying to figure out how do I move forward, adding to things that are serving me well. And I just thought, man, what a great reframe here, you know? And it just had to be part of this whole like thesis here of getting paid to hold risk. And again, if you aren't aligned with this stuff, like, and you are so like living in the day-to-day tick, like there's just this could be on the upside or the downside, right? Selling on panics, peeling off too early and ruining your asymmetry. Like one of the worst things I can imagine, and I've thought through this because I've been considering like where would I like to peel off per or do things like that. It's like if I'm going to be the guy that's agreeing with flows and putting my own conviction and my own risk early on the table there, why would I want to lop my head off too early? You're going to take all of this risk in this highly volatile product or asset. Yet if it goes up like 50%, like you're risking 40, 50% on it in the first place. Yet if it goes up 50%, you're going to say, that's enough for me. Like I would rather take that mindset to something that has a lot less volatility to make that return. So like you're going to have a lot of people that mismanage this on the downside from panicking and on the upside from taking some of that risk, that asymmetry, that premium that you're looking for and taking it off too early. So it's something to think through as you're taking like bigger, more volatile bets with a lot of premium embedded. When it's working, how you're supposed to be like managing that position. Just something, you know, kind of food for thought. So again, if we're just tracking it, we're starting off with the macro regime, which is all the work you do, having a good cost basis if possible, where that's like getting into a position with good charts, maybe on a good situation where there's a big pullback broadly and you could get into like a lower compressed volatility stop that sets up the asymmetry that allows you to hold and add through all of this, and that leads to insane outperformance in the moments that work out. And I just thought that's what that's wrapping up literally everything we're doing on stream here and hoping to embed into everybody that's viewing.
I love it. I love it. I think these are just such critical things to connect on. You have the view, you have all the models, you have all the tools, you have the information flow if you show up every single day, and you have the glue that kind of pulls it all together on all this stuff that you're laying out for how do you make good decisions, right? How is it that people that have every single opportunity in life still somehow figure out how to mess it up? And how is it that some people with the littlest opportunity and, you know, least tools in their tool belt seem to just figure it out? So I just think that's what, like, these ideas that you're pulling out, those are the differentiating factors for those things.
That's it. That's the slide deck there.
I love it. I love it. Are you enjoying your crayons on there, or what's going on?
You got to inspire people with a price target.
Well, here's your inspiration, guys. This is
now I'm going to teach you a little something about exit liquidity. See, my orders are resting at $98. You know, and then once per is at 90s, I'll go on CNBC or whatever, and I'll say like, this is been something it's tracking. It's the way of the world. It's going to hundreds of dollars, and now I'll be smoothly exiting in front of everybody. That's how it's done.
I always love the people that come on the TV and they're just like, well, yeah, 100 is such a psychological level, and that's we're right. Just gonna and they just frame everything around like there's just such psychology of all of us doing these things. So awesome. Well, everyone, thank you very much for joining the live stream today. You can go find all the work that I'm doing at capitalflowsresearch.com. It's linked everywhere, below and above and everywhere. You can go through all of James's work on his YouTube channel and his Twitter page. I'd encourage you to follow him, follow the work I'm doing. We'll continue to lay out all these things on the live streams that are every single day, 8:30 a.m. Mountain Standard Time. And then, we'll keep going through the entire dashboard that I have. People are asking really good questions about real interest rates? How does it connect to the macro environment? And, how do we pull those moving parts together for price action and things like that? And what I would say is, here's kind of a breakdown of the dashboard that I'm running and I go through every single day. What I would say is that when you pull all these pieces together, the main thing that you want to understand is what is the macro regime, which means what are the largest forces driving everything? How do I stay on the right side of those? And then within that, what are the positions that have the greatest asymmetry? And then once you have that, you have all the tools to make good decisions. And then you just actually need to execute on good decisions, which is why all of the work that James is doing and, the people he works with in his Discord and everything like that, I can't, recommend that enough for people. If you want a place where you can really, interact with people and have more of a community and connection and chat with James, all that happens in his Discord. You guys can chat with him if you want about that. Just message him on Twitter or go through any of his links and stuff like that. You guys will find it. You know how it works. But I appreciate everyone joining. We're going to continue to do these, and I'll have some more exciting stuff over the weekend. So with that, everyone, thank you. James, thanks for all the breakdowns that you provided, and we will catch you guys on Monday.
See you later.